This morning on the Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
All right, let's get to it. I always have a lot to discuss, and the first one we're going to talk about is an important one for many farm businesses because they don't come with an exemption unless they are an LLC or a corporation. But the key there is that they have they employ more than 20 full-time employees that file a tax return, and that's showing at least $5 million in gross receipts. This is about beneficial ownership information reporting.
Yeah, Greg, I want to cycle back and talk about this again. I was speaking in Missouri for the State Farm Bureau meeting, and there were several hundred farmers there, and I was doing an update. I spoke for 2 days, and my presentation on the second day, I was doing an update of agricultural law issues, and I mentioned this one, and I got inundated at the dinner of farmers saying, "What is this? I hadn't heard about this," and that kind of stunned me, because this is very, very important, and I've been talking about it, trying to get the word out about it. There's a new filing requirement that's going to hit a lot of farm businesses, and if you don't file these reports with the Financial Crimes Network of the Treasury Department, so this is IRS stuff, the penalty is $500 per day that you're late, capped at $10,000. And what this is it came out of the Corporate Transparency Act back in 21. It's going to it took effect starting at the beginning of this year. And what it says is, if you have a business and this is the easiest way to explain this, if you have a business that registers with the state, if you have to file something with the state to evidence that you're doing business in the state of Kansas or in the state of Missouri or wherever, if you have a filing requirement there, if you registered, then you have a filing requirement with this Financial Crimes Network. This is designed to get at money laundering activities. And you have to disclose who the beneficial owners of that business are, defined as those that have at least a 25% ownership interest, that exercise substantial control over a reporting company. Now, you mentioned an exemption here. And that's not going to cover very many farming operations, because you kind of have to think about this in reverse. If you're big, then you're probably exempt. If you're small, you're not exempt. So that threshold is, if you have gross receipts on a tax return showing at least $5 million, and you have more than 20 employees, then you're exempt. So the bigger ones are exempt because they already have a filing requirement of this ownership information with the Securities and Exchange Commission. Now they're coming after the smaller operations. So if I'm a sole proprietorship, but I'm organized as an LLC, I filed with the state to register my LLC, and even though I'm a one-person farming operation, unless my gross receipts are over $5 million and I employ 20 people, I've got to file this document with FinCEN, the Financial Crimes Network. And this is all done online. People need to go to FinCEN's website. It's FINCEN. Just type that in and type in beneficial ownership information reports. And all of this is done online. Now, this has to be done by year end if you were in business prior to 2024. You've got to file your reports by the end of this year. If you were created this year, if you're a new business this year, you have 90 days from the date of filing with the state. And then as we go further out into the future, once we get into next year and you create a new business next year, then it's 30 days from the time you registered with the state. And any time your beneficial ownership changes, any mix in that, you change in name, you change in address, you change percentage ownership, and somebody else gets a 25% interest, you have to refile your report to update it with FinCEN. So this is really, really important stuff people need to be aware of.
And from what I guess it had been earlier this month, there was actually a court case in Alabama specifically looking at this.
Well, it actually came down earlier this spring in the trial court. You're right, earlier this month. The the arguments were heard on appeal in the 11th Circuit in that case. But what happened was the trial court said all these requirements, this is unconstitutional on several grounds, and that is on appeal. And the oral arguments were heard on September 4th in Alabama, in that one, in the 11th Circuit, from that Alabama case. So we will see what happens. I've been telling people, I said this at the K-State tax schools and in my other seminars starting last fall, and that is I expect a challenge to be made on this. I don't think it's constitutional. Indeed, that challenge was made. Indeed, the trial court knocked it out as unconstitutional. But I'm telling practitioners, go ahead and gather the information from your client. If this stuff is upheld, you've got to be ready to go to file this stuff by the end of the year. Now, the thing is, Greg, on this, whatever the 11th Circuit says, the losing side is going to appeal. They're going to ask the U.S. Supreme Court to take this case, and I think the U.S. Supreme Court has to take the case. This is a really big deal, and they will fast-track this, and we'll have the decision, I think well before the end of the year. This is one of the things the Supreme Court will put to the front of its docket and get this clarified. But this is really important stuff. We don't want farming operations to get hit with these outrageous fines that could apply. $500 for every day you're late.
Best advice right now, get it done, or ask your financial person or lawyer as to what they need to do if you're a farmer or rancher out there?
Yeah, that's the thing. Who do you ask? Well, some would say your accountant, your CPA, some would say your lawyers. The thing is, nobody wants to do this because the practitioners fear the liability because the penalties apply if there's any change in the ownership structure and it doesn't get reported. And what we worry about as practitioners is our clients don't tell us everything immediately when they do something. And the requirement is you have to update your report within 30 days of the change. So the accountants don't want to do it. There are a couple of states that have ruled on the malpractice liability and whether this constitutes the unauthorized practice of law. Iowa says it does not. New Jersey says, yes, it is the unauthorized practice of law, but if it's just a simple filing, that can be done by a non-lawyer. If it gets more complex, for example, if you have a trust that's involved or an estate that's involved, then you need to have a lawyer do that. So this has really created a lot of angst amongst the practitioner community too, but this is something to pay attention to.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, another one coming up, and if you heard the agricultural law and tax report this morning, you talked about this, talking about the difference between nuisance laws and negligence laws, or the difference of, and in particular, for this case, where this plays in.
That's right. What if people didn't hear what I was talking about in that brief segment earlier this morning, what happened was that you had a company here, a natural gas company, that was granted an easement over a portion of a farmer's property that permitted the company to operate a natural gas pipeline. And so they used the cathodic protection system to run an electrical current through that pipeline. Well, what happened was all types of problems. The farmer then sued for nuisance on the basis of stray voltage from that system because of damages to his dairy herd. And the trial court awarded him damages, and the company appealed saying, look, the jury wasn't instructed properly by the trial court because we weren't negligent. And negligence is an element of nuisance. In other words, we can't be held liable for nuisance because we were doing everything the way we were supposed to. Now, I'm glad this wasn't one of my law students that argued that in court because I would have been really upset with them. This is Ag Law 101. This is basic stuff here. Nuisance and negligence are not the same thing. You can be operating your farming operation completely free of negligence and still be successfully sued for nuisance because they're different concepts. Nuisance involves conduct that falls below a standard. Negligence involves conduct that falls below a standard. Nuisance is totally different than that. It involves the question of whether the use of property unreasonably interferes with somebody else's reasonable use of their property. So those two concepts are completely different, and negligence is not an element of nuisance law. Nuisance law is how you use your property. And negligence is whether your conduct fell below a certain standard, and they're totally different.
All right, let's move on. And this is The next discussion we're talking about is part of the Inflation Reduction Act, and that, of course, in association with climate smart commodities, but in this case, talking about partnerships for climate smart commodities.
Yeah, Greg, that act back in 22 funneled millions of dollars to USDA for the purpose of enticing farmers to use farming practices that would reduce carbon emissions. So I want people to remember that as I talk about this, because there's something pretty illustrative, and I think it really exposes things that I'm going to mention here. So the USDA gets the money, and then they award the grant money to various national commodity organizations so that contracts can be entered into with farmers who will adopt certain practices, certain farming practices, and get paid upon certification that they have adopted those governmentally approved practices by a third party, certifications by a third party. Now, I got this contract to look at. It was a farmer that sent me this contract. Said, "Would you look at this and tell me what this thinks?" And it's called a producer agreement, and it was sent to him by a national commodity organization. And they're partnering with a third party to certify that the partner or that the farmer would adopt these particular farming practices. And I'm reading through it, and I get about 5 pages in, and there's this paragraph, and it says this organization who's partnering here will compensate producer. Now I'm reading the actual contract language for practices believed to contribute to lifestyle GHG or greenhouse gas emissions reductions. And then the key sentence. This compensation is in no way based on real or perceived soil carbon sequestration. There it is. That tells me right there the whole thing about adopting the practices so that we reduce carbon is not real. They're just having farmers adopt certain practices and farm the way the government wants them to farm, and will pay you for that. And it doesn't matter whether it reduces carbon or not. And that was specific. That is specifically stated. That is a direct quote in that contract.
Let's move on as Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, joins us. And to say the least, you get asked plenty of questions. And one of the things I'm sure you're asked by tax preparers with a client under an IRS audit is how to handle the audit. And I'm sure you have suggestions as to if there's that situation that arises, what they would need to do or what you would recommend that they need to do.
Yeah, and this is based on experience. I've dealt with IRS numerous times over the years, and here's my suggestion, and I tell this to practitioners at some of my seminars, and that is always meet any IRS response deadline. Watch your deadlines, always meet them. Don't miss a deadline. So if they say they want documents by a certain time, if they say they want X, give them X, do it by the specified time. Properly execute Form 2848, which is a power of attorney. You want to make sure you're completely authorized to act on behalf of the client. And then understand what the IRS audit triggers are. What are they looking for? And that includes business income calculations of all kinds. It includes math errors, unusual sources of income. Do you have foreign income? Do you have gambling income? Do you have a large amount of cash transactions? That's the kind of stuff they look for. Don't take public stances against the IRS. Remember Lois Lerner a number of years ago that went after certain organizations because they didn't like them. And on that point, it's probably not a good idea to name your business Middle Finger Ranch, for example, which is what a CPA did out in Colby, Kansas earlier this year, and now he's being prosecuted by IRS and the Department of Justice. Don't do that. You don't want to upset the IRS. And then determine whether it's a records audit. If they're after records, then you're going to have to provide documents either by mail or fax. And yes, fax. IRS still uses a fax. You may not have one, but IRS does. If the audit is in person, then the IRS is either going to want to meet at their local office or at your office or the taxpayer's house or home or ranch or farm or place of business. Meet at the IRS office or your office. In fact, when I was tax director of a firm for a short while a few years ago in West Des Moines, Iowa, we do audits at the office, put the IRS agent in a room, and crank the temperature down or crank the temperature up. Kind of naughty, but make it as unpleasant for them as possible, I guess. But we want them to meet at the office. The audit is an interrogation, and IRS is on a fishing expedition, and you don't want any answer either from yourself or from the taxpayer to broaden that investigation out into areas the IRS didn't find or wasn't originally interested in. And then only take necessary documents to the audit, those that respond to the IRS's request in the client's tax return. And then if they propose a settlement, you're going to have to determine whether it's acceptable. And if not, you could pay the deficiency and file a refund suit in local federal district court, or not pay the deficiency and go to tax court. So that's how I see the basics of handling an IRS audit.
Roger, one thing not sure we have talked about between you and I, but it's a question you have received a couple of times just recently, involves whether summer camp expenses for a child can qualify for the dependent care credit.
Yeah, Greg, I get this at least once every summer or in the fall, and I've had it come up a couple times already. And do those summer camp expenses for a child qualify for that credit, that dependent care credit? And the answer is it might. You might be able to treat the summer camp as child care and be eligible for a maximum $2,100 credit. Now, that is subject to a phase-out based on your income, but that's the maximum credit that's there. And that's available for children under age 13. Now, there's no age limit if the dependent child is disabled, but it's only available if the expenses enable you to work, among other requirements. The big one is enabling you to work. There are a few other requirements that are there. And if you get through all those hurdles, you're going to also need the business name of the camp, their address, and their federal ID number to be able to claim that deduction. So the answer is it's possible, but you want to make sure you got the right set of facts. You want to make sure the child is under age 13, and what we're talking about is dependent care credit.
All right, Roger, a lot of topics to discuss, and if people want more information or like to keep up to date on the latest things you're doing, they can go to your blog to get more information.
Well, these are not on the blog. I've created a new Substack, Greg, and that's McEowen Ag Law and Tax.substack.com, and these are kind of summaries of much longer developed pieces in my Substack, and that's on a subscription basis. But I did talk about one of these on the morning program, the Ag Law and Tax Report this morning, and I may put some of these on the blog in a different format in coming days.
Okay, sounds good. Roger, as always, I appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.